I just read this really important essay report by Ray Dalio about what's happening in the financial markets, the economy. Um, and in it, he's basically predicting that the stock market is going to fall 20% from here. Uh, is that right? Um, well, I'm going to talk about that towards the end of the video that I'm doing with you right now. What's really important, more important though, is to understand how he's getting to that argument. Um, and that I agree with. Whether it goes down 20%, put that on hold for a second. But uh, I'm linking to this essay he wrote, and you should read the entire thing. But it's in response, or it's been done, I should say, following last week's horrible CPI report, which showed that inflation is systemic. Inflation is not simply oil prices going up and commodities going up, but now it has spread throughout the economy into rents, uh, the amount people are paying for medical care, obviously what they're paying at the grocery store. And a lot of these things actually went up last month, despite the fact that gas prices went down. And inflation has been, in the stock market, took a huge tumble after that news came out. But it's been falling all year in a bear market already. It just simply had a counter trend rally in July and August that was short lived. Um, it rallied up the 200-day moving average on the S&P 500 and stalled out. But let's get to the Dalio essay. Now, I just want to, not going to read the whole thing here for you, but just some keys. It's obvious that inflation is now the targeted problem for the Fed. So obvious that central banks should tighten monetary policy. Everything will flow from that. So here's the deal. This has been obvious to anyone who's been following the statements of the Federal Reserve and what's going on in the economic data. That said, a lot of people that are trading the stock market forgot all about this or wanted to believe that it wasn't real, uh, because in July, so many people were out there claiming that inflation is going to go away and the Fed is going to pivot and actually start to lower rates before the end of this year. And therefore, the stock market would just go crazy. And that wasn't simply a bounce in a bear market, but the start of a new bull market. That's what people were saying in July, some in August, the same people basically. Now, a lot of these people had been saying that sort of stuff in 2021 when the inflation began. They're saying, oh, it's just temporary and go away. They're proven wrong then, and they're proven wrong again. But what is worse this last time is that they were saying these things, even though in multiple speeches in July, Jerome Powell was saying that he intends to raise interest rates throughout this year and to keep them up next year, not to lower them, because uh, he believes, and it's common for the Federal Reserve types and economists to believe this, that inflation, uh, when it gets ingrained in the economy, it becomes something that people believe is going to keep happening, and then they turn it into a self-fulfilling prophecy. So it's important for the Fed to beat down inflation expectations or prevent people from getting to the view that it's just going to keep happening. And the argument Powell made in the Wall Street Journal in July, despite all the people saying pivot, 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 and they're still saying it after they said this, was that they would have to raise rates and keep them up in order to beat down inflation long enough that people wouldn't think it's coming back. And now here we are where inflation has actually gotten worse inside the numbers. And people are at a dismissed pivot talk. And the odds of further rate hikes have increased, and the extent of the rate hikes have increased. Now, what I use is this tool, the CME Fed Watch tool. What it tracks is the Fed fund futures. This is what traders are projecting the path for interest rates is going to take. And they never were projecting, once this year began, at any point that there'd be rate cuts before the end of this year. So all the people that were telling you that, the gurus telling you that, were going against what the markets themselves were saying. They're going against economic data. They're just simply telling you what they wanted to believe themselves. They were not simply trying to fool their audiences, but fool themselves because they wanted to believe it, but they were wrong. And and what was worse is just based on nothing what they were saying. But this is reality, and I follow the market trends, the data, and tools like this. So what the Fed funds futures are now projecting are that the odds of rate hikes going over, or the odds are the Fed funds rate is going over 4%, and good chance it's going over 4.5, over 50% chance, almost 50% chance that it's going over 4.5, and just about certainly over 4. Well, that's an increase in the rate, or the end point of how high these hikes are going to go than there was a month ago. So the financial markets have gotten more hawkish on the path of interest rates, and that's why we're seeing today gold has been getting hurt, or it has gotten hurt, and the stock market is faltering, even though it just fell over 1,200 points a few days ago. No signs of real bottom. Yeah, it could go up before the close, but it wouldn't mean anything. The Dow is up just a little bit after what's been going on. So anyway, we're headed for higher rates. It's going to slow down the economy and the stock market, and that's what he is really. And he goes into depth on how this works in the economy, what this does. It raises the cost to finance investments. If you want to buy a home, the cost to buy a home goes up. The cost to issue debt, if you're a company to get financing, goes up. And all this, slows things down. The cost of credit goes up. And that's what is going on. And the stock market, gets hurt from this. It all starts with inflation, then goes into the credit markets, then goes into the economy, then goes into market prices and economic growth. And he is projecting in this article that the raising rates will get to 4.5%, which is what the bond market is saying. And I agree with that. I completely agree with that. And that's where he's getting this idea that that's going to create a 20% decline in the stock market. Now, he does not explain in here where he's coming up with that figure. Why not 15%? Or why not 40% for that matter? Why 20? Now, and what do I think of 20 from here? Well, let me show you this chart. This is the S&P 500. This is a weekly chart. Usually I use daily charts. I almost rarely use a weekly chart, honestly. But here's the daily chart of the past 12 months. And to me, the most important indicator to just quickly figure out what's going on in a market is a long-term trend, which is the green, which I identify by looking at the market, the stock sector, whatever we're looking at on the chart, and how it's acting with its 200-day moving average, which is the green line on this chart. In a bull market, you trade above the 200-day moving average, it acts as support. In a bear market, the opposite happens. The opposite's happening. We're in a bear market. In July, we rallied up to that 200-day moving average, could not close above it, and the rally peaked. And it's been slowly sloping down. And here we are on a weekly chart. And what I've drawn on here is you can see these two lines going down on the S&P 500. That's basically a downtrend channel for the bear market so far. So we can project the price pattern based on this downtrend channel. Now, the decline will end when the bear market ends. And bear markets typically end, or they, not typically, but always, end in a panic washout, a capitulation of stock market bulls and investors. And we have not seen that all year. We saw it in March 2009. Even in corrections in bull markets, you see panic where the VIX can get over 40. We haven't even seen that happen in this bull market. 2020 was a crash. So, I mean, it obviously happened then, but there is a capitulation in 2018 when the VIX got above 40, the market fell 20%. In 2016, in the first quarter, a panic decline. In 2017, the Dow had a crazy flash crash session and the VIX skyrocketed. In 2011, 2012, the VIX got to 40. Not this time. In fact, it remains below 30. So there's been no signs of panic or a washout. And the bear market will end when that happens. So the other thing I've drawn in here are Fibonacci retracement levels. Now, I'm not, people that talk about Elliott wave theory like to use these things. I'm not a proponent of Elliott wave theory, but retracement levels are useful. So if we look at the retracement levels of the 2020 low and the high of last year, what we see is we've already gone through the 1/3. These retracement levels typically act as long-term buy levels too. We've already gone through the 1/3 retracement level, and we've just hit the 50% retracement level or gotten close to it. It's right below 3,500. So you could say the July decline hit the 50% retracement level. Now, it's not unusual for a bear market to end on that level. So another way to put this to you is that the decline that we saw from January, you know, to this to June, that we had that final plunge in June, was big enough that historically it could be the end of a bear market. It was big enough that that was possible, but it was not, because there was not a panic washout, and we rallied up to turning moving average and stalled out already. So it's highly likely we're going to break that level before the end of this year. And another reason to believe that is because of what the stuff in this Ray Dalio article. You know, the path of the interest rate hikes is going to continue through next year, not simply end next month or next week when the next meeting is. It's going to continue. And the only thing that would make it stop, you know, before that projection by the Fed fund futures, is if the market crashed before then. But I don't believe that's going to happen. I see no evidence to tell you that the stock market's going to crash. So this is a slow, drawn out bear market, and bear markets also is about a month ago. We had a discussion, and he pointed out that bear market bottoms typically end 90 days before a trough in a recession. Well, that's next year too. And I point out in other videos that the futures market for real estate is projecting that real estate prices are going to pull back like 14% from their high, but not bottom until the fourth quarter of next year at some point. So that's a year from now, at least 12 months from now. That would be happening at the end of a recession or trough. So, I don't think the bear market's going to end this year. Just don't. I mean, that's just. I'm telling you why. So that takes us to the next retracement level, 3190. Now, here's the interesting thing about that level. Dalio's 20% decline from here matches with 3190. They line up. Now he doesn't talk about that in his, this. I'm sorry, it's a 64%, 2/3 retracement level is 3190. 50% is 3498. But that 2/3 level is 3190. And it matches Dalio's 20% decline from here, almost exactly. Now, he doesn't mention this as a retracement level, but he's probably looking at it, or his team is, because he doesn't have any other explanation of how he's coming up with that prediction, whatever you want to call it. Now, do I think that's what's going to happen? Well, if it does go there, you can see if that is where this ends, you can see by the downtrend channel I've drawn that we could be getting there in the first half of next year, early spring, possibly summertime. Well, that could line up with the trough of a recession coming, in the fall. Or fourth quarter yet. So it's a possibility. It's a much more likely scenario than people telling you that the stock market is gonna pivot because the Fed can't raise rates because they always cut when the stock market declines. Well, that was up until now. That was up until this cycle when inflation has gotten out of control. Inflation was never out of control since the 1970s. And that's why the Fed's not acting the same way people were telling you they would act in July. They don't want to recognize that, and this is real, what's happening. We're not in, it's just that what the world is not what people thought it was or were telling you it was. Now, here's the thing. That idea of a 20% decline from now or a bottom at 3190 is a projection. I'm not really sure what the odds of it are. We could go lower than that. I guess another way to put it is, I think the odds are great that the stock market is going to go to that level, but it could go further than that level too. If the recession is worse than people expect, or if people in the stock market simply panic much more over things than and a panic kind of overshoots, because that could be a problem in markets. You can markets often overshoot to the upside and then overshoot to the downside too. So we could overshoot selling too much at the end of this bear market and bust through 3190, and that break of 3190 could trigger a panic sell off for a month or something. So I'm not personally trying to predict myself where this exactly where the exact price point is that this is going to end. What I'm really trying to do is keep my eye on things, watch this unfold, and prepare myself to be a buyer when the time comes, to be a buyer when the panic washout comes and this bear market comes to an end. And to do that, I don't want to be buying into sucker rallies like the last one we saw. I want to be very patient. I'm ignoring the gurus like Kathy Wood and people, many you see on CNBC who keep claiming that we're pivoting, inflation's going away, and then each time the data comes out, they're wrong. At some point, and read the Dalio article, they're correct. The inflation is going to come off the high and come down. But if you read the article, he also is suggesting it's not going to get down to 2%. He sees it stabilizing around 4%. And I think that's probably correct. And a big unknown is what happens after that. What happens in 2024 with inflation and interest rates? And yeah, so all I can do from the charts and data is see what the current trend is. And it gives me an ability to look like 6 months out. And the forecast beyond that, it's really just pure guessing. And I'm not interested in trading and making investing decisions based on simply guessing what things way out in the future or on hopes. We're in a bear market. I want to see the bear market end before I really start being a big buyer again in these markets. And I'm willing to be very cautious until that happens, to have big cash positions, to be ready to deploy them when the time is right. What I find useful about articles like the Ray Dalio article is not the headline prediction. Other people are talking about it, the 20% drop. It's to understand how he gets to that. That's really the least important part of the article. The article is a great educational piece to help you understand why the Federal Reserve is raising interest rates, what's going on with inflation in the economy, in the stock market, how all these things interact together. Because so many people in these markets really don't understand these things. They started getting in 2020, and their main tool to interact with the financial markets is apps. It's Robinhood. It's simply loading up an app and seeing the price up or down in any given day and seeing lists of things that other people are buying. That's like trying to fly an airplane completely blind. Or try to, it's like, on an airplane, you got all these indicators on the dashboard to help you. But the equivalent of using like an app trading and flying, and that's how you're flying an airplane, would be as if you're flying blindfolded. You're not looking at anything that's meaningful or useful at all. It's like flying the airplane at dark with the indicators and the lights in the cockpit turned off. And you need to, I can't fly an airplane. If I wanted to fly an airplane, I would have to take lessons. I'd have to get help. I'd have to learn how to fly an airplane. So people got into the financial markets thinking it's easy. It's easy money. And people told them that. Robinhood makes you believe that. The gurus tell you that. It's not true. You got to know how this things work. And if you don't understand what makes interest rates go up and down and how that interacts with the financial markets, you don't know what's going on. So read the article. And if you want me to do more articles about this or videos about this, hit like. And if you're new to me on YouTube, hit the subscribe button, hit the bell next to it, and YouTube will send you an alert as soon as my next video is up.